Oh, good grief. I thought I was having some trouble in the market today. I was scared, down 3%. I was crying in my boots. But here's Palo Alto down 13.5% after hours on top of down 2.5 during the normal trading session, which means this guy was down a solid 15% today. Good grief. Good grief. So the question is, what happened with Palo Alto that made this happen? And yes, that's how I'm going to say it. I promise you I'm not pronouncing it incorrectly. So Palo Alto, it's a company I haven't looked into that much, actually, surprisingly. Obviously, big tech being in, it's surprising I haven't, right? But they put a non-GAAP EPS of $1.19, which beat by 7 cents. So that's a really good number, right? A GAAP EPS of negative 75 cents, missed by 34 cents. Oh my gosh, that's horrific. That is horrific. Are you kidding me? Negative 75 cents. This company losing money like no other. See, this is why, obviously, GAAP exists, generally accepted accounting practices, right? So that way everyone can have the same standard of reporting. Now, clearly, if you're looking just off the non-GAAP EPS, which is numbers they've fudged a little bit, all right? They've made these numbers look good. They beat quite a bit, it's a good number. But then you look at actually what's happening with this company, negative 75 cents a share. Holy crap, that is ugly. This is not a profitable company, apparently. Yikes. What in the world do you do there? From a revenue perspective, about 15% year over year, $816 million. They missed by $25 million, though, so that they even missed on that aspect. It's scary stuff. You wonder what's going on. This is a $200 stock with a market cap of $23 billion. It's interesting valuation on this company right now, I can tell you that. So let's look at some of the finer details. Look at this dude on the left with this stash. He definitely looks like, I'm just going to tell you, I don't want him to be my neighbor. That's all I can tell you. I don't want him to be my neighbor. That's it. Palo Alto down big. Reports Q2 results that beat EPS estimates but missed on revenue. No, they didn't beat EPS estimates. Sorry. Downside outlook has a revenue of $835 million to $850 million. Consensus of $873 million. So quite a bit down on. Microphone attacked me. Hit me right in the chin. I don't know if I'll be making it. So wish me luck. But obviously quite a bit down compared to what their consensus was, and on an EPS perspective, very down from what their consensus was as well, only expecting 96 cents to 98 cents in terms of non-GAAP EPS. The lowered full year guidance has been turned down as well, so full year they're expecting less than what they had previously, and definitely less than the consensus. That's crazy stuff. So the Palo Alto board has approved a $1 billion accelerated share repurchase transaction with a financial institution. Palo Alto plans to enter into the transaction in Q3. Okay, that's interesting for them. Quarter 2 billings totaled $998 million, up 17% year over year, above the consensus. So that was a good thing for this quarter. Product revenue was $246 million, and subscription and support revenue is $570 million. That is, there's some good stuff to this. The guidance obviously is weak, no doubt about it, but the share repurchase is good as well. I think that is a good aspect for them. I just want to see what anyone says here. Where's this good stuff? Anyone got a good comment? Still too pricey. Ooh, needs a 50% haircut? Ding dong. This guy Ding Dong here, just what a man. I respect Ding Dong. I respect Ding Dong. It's good snack food, no doubt about it. Sorry. Anyways, what are these good things we want to look at? I think there's plenty of things we need to look at in terms of this. So, non-GAAP net income for the fiscal year was $120 million, but iffy stuff. Can we look at the actual numbers? That's what I'm going to look at. There's no doubt about it. So, obviously, we saw this guidance. We saw that adjusted free cash flow margin of approximately 28%. Cool for them. I want to see this normal GAAP EPS because I think it'll be interesting to see, but I don't think they show it here. But I think it will be important, obviously, just to take a look in terms of GAAP net loss, which is what we want to see. All things considered, hear me out, this is horrible. Take a look. Take a look at these numbers. These numbers are freaking stupid. Look at the difference. Quarter over quarter. They've lost, that's right. 70 million more. 70 billion. Sorry. I'm just kidding. It is $70 million more. Almost got you there. If it was $70 billion, we'd have probably the biggest issue in the world. But yes, they lost $73 million in this quarter. Yikes. For the full year, just 6 months ending, they lost $133 million versus last year. During the same time, they lost $40 million. That is what I would like to say, not good. Not good. That's all I can really tell you there. But if you fudge the numbers a little bit, if you get rid of these share-based compensation charges, you can get eventually a non-GAAP net income of $120.3 million. So you could fudge the numbers all you really want, and you can make it look good. That's the thing about non-GAAP. Yikes! If we look in terms of current assets, I do like to look at that. You know that. So they've doubled their cash position, which is quite nice year over year. Actually, this is 6 month ending period. They doubled their cash position, which I like. I like that. There's no doubt about it. So same in terms of accounts receivable, stuff like that. Total assets of nearly $4 billion. How about I say that? Which is up from where they were at 6 months ago. Cool stuff for them. Not by that much, but overall, I like it. They obviously had a lot more short-term investments that I guess they must have taken some cash out on, I'm guessing. From a liabilities perspective, they have a total current liabilities right here of $2.2 billion. So, to be frankly honest, all things considered, I do want to say this is not an ugly looking balance sheet. It's not too ugly. How about I say that? I don't think it's that bad of a balance sheet. I just got to be honest with you. Overall, cash to revenue or cash to debt, I kind of like it, but I don't know if I like the fact that they've increased their losses so significantly year over year. That could just be me. Maybe I'm just a guy who needs to calm down and quit being such a snob. And maybe I should let companies lose as much money as they want. But I don't like the lack of profit with this company, because without a profit, I think it's very hard to actually value a company and see what it's actually worth. Because if they're not actually bringing money in the door, I don't know if there is a value to them. In my perspective, it's really hard to value a company that doesn't bring in profits, because at any point, this company could decide, if they can't get investments into them, then what do? Overall, I think I would agree with Ding Dong, okay? This stock's still a little bit too pricey. I think it's flown up just because of all the hype around Silicon Valley, tech stocks, just all going wild over the last 3-4 years. If you look at Palo Alto stock over the past 5 years, nothing absurd, but still is a solid 66% up from lows in 2017. It's actually up over 100%. So really, that's the number we like looking at. It's over a 5-year basis. It doesn't have a chart available, so anyways, still, I think it's an interesting one. I just don't know if the value's fair for it right now. But I understand why it does have the valuation that it does. I just don't know if I necessarily agree with it, so I'm not going to be picking up this stock even after this mega drop. I think it is an interesting one. I do think it will rebound. I just don't know when, but I do think it will rebound. I don't think it's the end of the world for this stock, and I don't think it's going to be going down, to anywhere where I would buy it, which would be right around 170, maybe 150. Probably 150 is where I'd rather take it at, just because I don't know where the valuation stands for this company, but I think they're doing good things, and I think the business it's a good business overall, good balance sheet, but I just don't like I don't like the lack of profit in my perspective. But I hope you enjoyed.